Okay, let's unpack this. We're jumping into a deep dive today, focusing on a really specific piece of communication, the 2019 shareholder letter from Goldman Sachs. This one was penned by the chairman and CEO, David M. Solomon.
And what makes this letter particularly fascinating, I think, is its timing.
Exactly.
It's reflecting on 2019, which was, a solid year by their account, but it was actually printed mid-March 2020.
Right when everything was changing.
Precisely, right
Yeah.
as the global health crisis, COVID-19, was really taking hold. And the letter actually addresses this immediate upheaval right up front. It creates a really unique context for everything else in there.
Yeah, it really does. So our source material is this detailed letter. But like you said, we're not just going to read through it, section by section. That would be very interesting.
Right.
Our mission today is to use a kind of unique lens. We're going to treat this letter almost like an interview subject.
Okay.
We'll use the types of questions you'd ask someone in an interview, about their background, values, strengths, future plans, that sort of thing.
To sort of pull out the key messages.
Exactly. To uncover the most important nuggets and insights Goldman Sachs wanted to get across, especially at that really pivotal moment.
Yeah, it's a good way to look past maybe the formal corporate language and get to the core priorities, especially when they're suddenly staring down a global crisis.
Absolutely. So let's jump in. Let's see what we can learn exploring this letter through this interview lens.
Sounds good. Where should we start? Maybe setting the scene, like you would in an interview, asking about the background, the context.
Perfect. So looking back at 2019, according to the letter, what was the overall environment like for Goldman Sachs?
Well, the letter paints a picture of broad-based growth globally in 2019. They mention subdued inflation, unemployment falling to multi-year lows in many places. So the general economic outlook felt pretty positive, pretty stable.
Okay.
Although they do note they were keeping an eye on geopolitical risks, throughout the year.
It's standard practice, I suppose. So against that backdrop, that generally positive global growth, how did the firm actually do financially?
They reported what the letter calls solid results. Net revenues for the year were $36.55 billion.
Okay, solid number.
Yeah, and importantly, their return on average common shareholders' equity ROE, which is, a key profitability measure, was 10.0%.
10% ROE. And how did the different business lines look?
Pretty robust across the board, according to the letter. Investment banking had a strong year, $7.60 billion in revenue. That was their second highest ever, and they kept that #1 spot in M&A advising.
Still number one there.
Yep. Global markets brought in $14.78 billion, helped by growth in financing. Asset management, $8.97 billion, good client inflows, strong equity investment.
And the newer consumer side.
Right. Consumer and wealth management hit a record $5.20 billion in net revenues. They described it as rapidly scaling. And firm-wide, assets under supervision grew too, reaching a record $1.86 trillion.
Wow, okay. So 2019 sounds like a good year financially. But as we mentioned, the letter doesn't just stick to the past. It immediately brings up the health crisis.
Right.
What does it say about COVID-19's impact, writing right there in March 2020?
Yeah, it's striking how upfront they are. Right at the beginning, it explicitly mentions the extraordinary pressure the crisis was putting on, everyone, society, companies, nonprofits.
Acknowledging the reality.
Totally. It notes government action was swift, aggressive, but they're also honest, saying it's too early to know the full effect the pandemic will have on the global economy.
Which was definitely true then.
Absolutely. But they also stress the firm is taking action, focusing on supporting their people, their clients, confirming they have business continuity plans ready, apparently informed by past crises.
Okay.
And they state their aim is to help rebuild the economy eventually from this devastating crisis. So this immediate context of uncertainty, it really frames the whole strategic review that follows.
That pivot is really significant. So shifting gears a bit, if we were interviewing the firm, trying to understand its core identity, we definitely ask about purpose and values. What does the letter say defines Goldman Sachs?
Well, the letter states their mission is to advance sustainable economic growth and financial opportunity across the globe.
Pretty broad mission.
It is. They talk about drawing on their 150-plus years of experience, mobilizing people and resources to help clients, broaden prosperity, accelerate progress, that kind of thing. Delivering on that purpose, they say, is how they create value for shareholders.
Okay. And they boil it down to 4 core values, right? What are those?
Partnership, client service, integrity, and excellence.
And the letter gives a bit more color on each one, doesn't just list them.
Exactly. So partnership, they say, isn't just the leadership. It's a philosophy for how they deal with clients, stakeholders. It's meant to foster ownership, collaboration, teamwork, always putting clients first.
Makes sense.
Client service is described as, like, a long-term dedication. It goes beyond just the transaction. Advice, knowledge, feedback, those are the key value drivers.
Okay. And integrity. That one seems particularly important given some history.
Very much so. It's framed as an unrelenting commitment to doing the right thing. And they're quite direct here. The letter specifically mentions being keenly aware of how the actions of a fear can harm our firm in the wake of our experience in Malaysia.
Ah, okay. So they address that head on.
They do, and commit to learning and improving from it. Then finally, excellence. That's about delivering their absolute best, attracting top people, making sure their advice is top tier, exceeding expectations. They even mention examples of people going the extra mile.
So those values sound, well, foundational. How does the letter connect these ideas to what they see as their competitive advantages? What makes them stand out?
They list several strengths that they see as self-reinforcing.
Okay, let's break those down. What's first?
First and foremost, they really hammer home their exceptional talent. They believe it's their biggest strength.
Their people.
Their people. The letter says clients consistently tell them that's what differentiates the firm. They see their whole system, their ecosystem, as attracting and developing the best talent.
8 proof points.
They point to the numbers, like 85,000 applicants for just 2,600 campus positions in 2020. They see that as proof they can attract people. They also talk about their talent pipeline, development programs, and this idea of an aspirational brand.
Okay, talent first. What else? Innovation.
Yes, culture of innovation is next, and they link it closely to their people. They say the firm is positioned to capitalize on new opportunities, and they actively encourage innovation everywhere.
And being Goldman Sachs, global reach has to be in there.
Absolutely. Their truly global presence is listed as a major strength, serving clients wherever it matters. They point out international net revenues have grown like 22-fold since 1990.
Wow.
Yeah, and now make up about 40% of their total net revenues.
Okay. What about relationships?
That goes hand in hand with global presence. The depth of client relationships. They position themselves as a trusted advisor, known for quality, long-lasting relationships. They emphasize this takes investment, patience, often decades.
Right, not just transactional. And the last one, probably risk.
Critically important, yes. Their robust risk management culture. They call it one of their most important strengths. They talk about strong processes, deep analytics, empowered functions, a culture of honesty, communication.
Covering all the bases.
Yeah, acknowledging risks are financial, operational, technological, reputational, and stressing the need to constantly adapt, question, and improve their processes.
So great people, innovation, global reach, deep relationships, and managing risk. That's the foundation. How does the firm plan to use these strengths moving forward, especially given that early 2020 context? What's the strategic direction?
Well, this gets into how a firm with, so much history adapts. The letter talks about cultural and operational shifts. They call it a new operating approach.
A new approach. What does that mean practically?
They say they're making a conscious effort to be more open and accessible, both inside the firm and externally to the market.
More transparency?
Seems like it. Examples they give include the new way they report segment results, aiming for more transparency and accountability there. And they also point to holding their first ever Investor Day back in January 2020 as a key part of communicating their strategy openly.
Okay. And any specific initiatives aimed at clients within this new approach?
Yes, a big one is simplifying how clients interact with the firm. They call it One Goldman Sachs.
One Goldman Sachs. Catchy.
It is. The idea, launched apparently on the CTO's first day, is to deliver the firm's full range of capabilities more holistically, less siloed. By the time the letter was written, they'd already applied this to about 30 major clients.
And planning to expand it.
Yeah, the plan was to expand it to about 100 clients in 2020, aiming to deepen those relationships and ultimately drive better returns.
It sounds like there's also an internal shift in focus happening.
That's right. The letter highlights a shift towards promoting more long-term thinking and investing. They're evolving the culture, the incentive structures, using a multi-year planning process to encourage those future investments. They do acknowledge this needs patience, fortitude from everyone involved.
Right. Shifting focus takes time. And the letter laid out specific financial goals, didn't it? from that investor day.
It did. These are medium-term goals, so think 3 years out. And they frame them in the context of a normalized operating environment, which is, an interesting caveat
Yeah,
given when this was written.
definitely. What are the targets?
Okay, so they're targeting a return on equity, ROE, of greater than 13% and return on tangible equity, ROT, greater than 14%.
Which is up from the 10% they hit in 2019.
Correct, a significant step up. They're also aiming for an efficiency ratio, basically cost relative to revenue of around 60%.
Getting leaner.
That's the goal. And finally, a CET1 ratio, that core measure of financial strength, targeted between 13 and 13.5%.
Okay, so those targets, higher returns, better efficiency, signal a clear push. What about longer term? Beyond 3 years.
Longer term, so 5 years plus, the strategy aims for mid-teen or even higher returns. They expect this will come as their investments in some of the newer businesses and technologies start to mature.
Which ones did they mention?
They specifically call out Marcus, their consumer banking platform, the Apple Card partnership, and their new transaction banking business as examples. They describe the early results from these as more than encouraging.
Okay, ambitious targets. Now, the strategy to actually get there is built on 3 pillars, according to the letter. Let's walk through those.
Right. The 3 pillars are 1, growing and strengthening existing businesses, 2, diversifying products and services, expanding their market, and 3, operating more efficiently.
Got it. Let's start with pillar 1, growing and strengthening existing businesses. Where are the big opportunities they see in their core operations?
This is really about building on what they already do well. Being number one in investment banking, a leader in global markets, top asset manager, premier ultra high net worth wealth manager in the US.
So leveraging those positions.
Exactly. Specific growth areas they mention include expanding their investment banking coverage further down market, covering more companies in that $500 million to $2 billion enterprise value range.
Ah, the mid-market.
Well, precisely. The letter points out they only covered about 44% of public companies this size in the Americas and EMEA, compared to over 95% of the really large firms. So they see a big untapped market there.
Makes sense. What else in pillar 1?
They also plan to optimize global markets for better returns, scale up their advisory-led asset management, targeting $250 billion in traditional asset inflows over 5 years. And in wealth management, accelerate growth in EMEA and Asia and aim for a 30% increase in advisors globally over 3 years, specifically for that ultra-high net worth segment.
Okay, so getting more out of the core. What about pillar 2? Diversifying products and services and expanding the addressable market. This sounds more like new ventures.
Yeah, this is where they're aiming for more durable revenues, better capital efficiency, and an improved funding mix, like getting more deposits. The letter identifies 4 big opportunities here. First is transaction banking.
Transaction banking, like cash management for companies.
Exactly. Building a high-tech, low-touch platform for corporate cash management, payments. They see a pretty significant 5-year plus opportunity there, targeting $50 billion in deposit balances and $1 billion in net revenues.
That's a big target for a relatively new area for them. What else?
Second is alternative. So private equity, real estate, credit, hedge funds, they plan to unify their investing platforms here and really expand. The letter notes they were already a top 5 player with about $320 billion in alternative assets at the end of 2019.
And the target there?
Aiming for $100 billion in net alternative asset inflows over 5 years.
Okay, substantial. Third diversification area.
High net worth wealth management. This is about complementing their traditional ultra high net worth business by reaching clients with, well, still significant wealth, but maybe not quite at that top tier. They're using acquisitions like ACO and the rebranded United Capital, now Goldman Sachs Personal Financial Management, to do this.
And the opportunity there.
They highlight that the U.S. high net worth market is huge, like $18 trillion, and very fragmented. They note they have less than a 1% share. So the thinking is, even a small market share gain could mean a meaningful revenue boost.
Right. Lots of room to grow. And the final diversification push.
That's digital consumer banking, basically building the digital consumer bank of the future through platforms like Marcus, targeting spending, borrowing, savings needs for consumers.
Another big ambition. Any numbers?
Yeah, they envision a 5-year opportunity, including $125 billion in deposit balances, $20 billion in loan and card balances, and reaching millions of new customers.
Wow, those are some very specific, very ambitious goals for these newer areas. Okay, so that covers growth and diversification. The third pillar was efficiency. How does the letter detail operating more efficiently?
Right. This involves streamlining the organization, making the client experience better, deploying people effectively, especially with that one Goldman Sachs initiative.
Cutting costs, essentially.
Partly, yes. They outline specific process efficiency initiatives targeting $1.3 billion in run rate operating expense savings within 3 years. But it's also about funding. They're working to improve their funding profile, getting more diversified funding through deposits, aiming for $1.0 billion in run rate interest expense savings in 3 years.
So saving on both operating costs and interest costs.
Exactly. And also optimizing their capital footprint, like reducing some on-balance sheet equity investments and alternatives. These efficiency efforts, the letter says, are meant to supplement the growth strategy, drive higher margins, and ultimately better returns.
Okay, that makes sense. Now, beyond the purely financial strategy, the letter also highlights diversity and inclusion and sustainability, calling them strategic imperatives. How does the firm frame those?
Advancing diversity and inclusion is described as a personal priority for the CEO. It's positioned as, well, essential for the business, the right thing to do, something clients expect, and something employees demand.
So, multiple drivers, any concrete examples?
Yeah, they point to strides in 2019. Their most diverse incoming analyst class ever, 49% women, 63% ethnically diverse, and their most diverse managing director class ever, with a record 29% women.
Okay. Progress at entry and senior levels.
And to speed things up in the middle and senior ranks, they announced a new global practice, interviewing at least 2 diverse, qualified candidates for every VP level and above role. They also highlight introducing what they call the industry's leading parental and family leave policy.
Right, and there was that very specific, very public action regarding IPOs mentioned too.
Yes, that definitely got attention. The letter states that starting summer 2020, they would only underwrite IPOs for companies in Western Europe and the US if they had at least one diverse board member.
Just one to start.
One to start, rising to 2 diverse members by 2021. They frame this as giving the best advice to their clients going public, arguing that board diversity brings long-lasting benefits to companies.
Interesting framing.
Yeah.
Okay, what about sustainability? The letter seems to view it quite broadly.
It does. It's explicitly positioned as not just peripheral or only about environmental impact anymore. The letter says the concept includes how a company conducts its core business and sees it as central to our long-term success, having a clear commercial rationale.
So a business case for sustainability.
Exactly. And they made a big commitment. A 10-year target to facilitate $750 billion in financing, investing, and advisory activity by 2030, focused specifically on climate transition and inclusive economic growth across 9 areas. They also set up a new sustainable finance group.
$750 billion is a huge number. Does the letter connect their philanthropy to this too?
It does, briefly. It mentions using philanthropic capital to align with these sustainability and inclusive growth goals. It highlights their signature programs, 10,000 Women and 10,000 Small Businesses, which provide education, capital, mentorship to women and small business owners globally. They noted some 2019 milestones, like an anniversary for 10,000 women in China and expansion for 10,000 small businesses in the U.S.
Okay, so that covers a lot of it. Strategy,
Sure.
finance, D&I, sustainability. As the letter wraps up, looking ahead from that early 2020 viewpoint, how does it summarize the firm's position and outlook?
It basically says 2019 was about defining the plan and goals, sharing them at the Investor Day, and that the key pieces of that plan are now in motion.
Does it suggest the firm is fundamentally changing who they are?
It acknowledges that the Goldman Sachs of 2020 and beyond will still resemble the past: core values, culture, key businesses, the ethos of putting capital and ideas to work.
Body.
There's a but. It explicitly states their approach to the world and their mix of businesses are progressing. And it calls this evolution healthy and even vital for their future success.
So change is necessary. And the closing thought, it brings us back to the start, right?
It really does. It's a powerful reminder that the operating environment can shift overnight, a point hammered home by the pandemic mentioned right at the beginning. The key takeaway, according to the letter, is that no matter the market conditions, the focus has to stay on what sustained them for 150-plus years. Their people, their culture, and crucially, the evolving needs of our clients.
And doing that is the key to success.
Doing that, they believe, is what positions them to compete and deliver those higher, more sustainable returns for shareholders.
So we've really gone deep into this Goldman Sachs 2019 shareholder letter today. We use that interview question structure to guide us through their 2019 performance recap, the core values, their strengths, that detailed strategic plan with specific targets, and also their commitments to D&I and sustainability.
And all viewed through that really interesting immediate context of early 2020, right as that uncertainty was hitting.
Exactly. It really is fascinating how much insight you can pull from a formal document like this when you approach it with a specific set of questions. It tells you a lot about priorities, challenges, both ongoing and sudden, like the pandemic, and their vision for navigating what's next.
Yeah, you really get a sense of their focus.
You've heard about those strategic pillars growing the core, diversifying into areas like transaction banking and digital consumer banking, driving efficiency, all backed by those ambitious financial targets and concrete steps like One Goldman Sachs or that IPO board diversity rule.
And we've also seen how much weight they place on the intangibles, their talent, the culture, those deep client relationships, and that robust risk management framework. They clearly see these as just as crucial as the financial metrics and strategic moves.
Okay, here's where it gets really interesting and maybe something for you, the listener, to think about based on everything we've discussed today. Given that detailed strategic plan and those specific financial targets laid out in the letter, but also considering that sudden, explicit acknowledgement of an unpredictable global crisis like COVID-19 right at the start, which factor presented within the letter itself do you think is ultimately the most critical for Goldman Sachs' ability to successfully navigate that kind of unexpected disruption and still achieve its long-term goals? Is it the meticulously defined strategy and targets? Is it the stated focus on its people and culture? Or is it that robust risk management framework they emphasize?